Hey everyone, welcome to today's Explainer. We absolutely love taking dense corporate data and uncovering the real story hidden underneath all those spreadsheets. Today we've got a genuinely fascinating financial narrative to unpack, the fiscal year 2026 results for Solar Industries India Limited. If you're into understanding the exact mechanics of how a company successfully scales up, you are in exactly the right place.
You know, decoding dense earnings reports really requires sharp corporate analysis. It's not just about staring at a mountain of numbers. It's about connecting the dots to reveal the fiscal reality behind them. When we analyze a company's performance, we're hunting for the story. How are they managing costs? Where's that revenue actually coming from? Well, today we are unpacking a story of just incredible momentum.
61%. Seriously, I want you to hold on to that number for a second, because what we're exploring today is a staggering 61% jump in Q4 net profit for Solar Industries. That's what the company actually takes home after every single expense is paid. Think about that. When a company operating at this massive scale manages to spike its bottom line profitability by more than half in just one single quarter, it absolutely demands our attention. So, how did they pull it off? Let's find out. All right, here is our roadmap for today's Explainer. First, FY26 as a record year. Second, the Q4 profitability surge. Third, analyzing operating costs. Fourth, the sectors driving the growth. And finally, assessing financial health.
Section 1. FY26, a record year.
When you review these full-year figures, the first thing that really stands out is the consistency. Net sales surged by 30%. But when you look further down that income statement, at EBITDA, profit before tax, and profit after tax, they all grew by 35 to 36%. This is super fascinating because when profits actually grow faster than sales, it proves the business is becoming more efficient as it expands. Basically, they're keeping a much larger chunk of every single dollar they make. Moving from roughly 7,500 crores to nearly 10,000 crores in a single fiscal year is just a massive leap. It really highlights a company that is aggressively expanding its capacity and effectively capturing market demand. Section 2. Q4 profitability surge. Now focusing just on the final quarter, the percentage changes are striking. Sales spiked by 41% year over year. But get this, EBITDA rockets up by 59%. Profit before tax jumped 64%, and there is that staggering 61% spike in profit after tax we teased earlier, moving from 346 crores to 556 crores. This tells us a crucial piece of the puzzle. The final quarter wasn't just about pushing higher volume, it was significantly more profitable volume. Section 3. Analyzing operating costs. The real driver behind this efficiency becomes crystal clear when we evaluate the materials consumed. Back in Q4 of the previous year, materials ate up over 54% of net sales. Fast forward to Q4 of FY26, and they squeezed that down to under 50%. Let me tell you, reducing primary input costs by nearly 4.5 percentage points while simultaneously growing sales is incredibly difficult to execute. It means for every single product they sell, less money is spent making it. That is the foundational driver for those massive profit surges. Now, employee costs did shift slightly from 8.01% to 8.27%, but that's a completely normal fluctuation when you're aggressively scaling up operations. The savings in material consumption heavily outweighed it.
So, we've seen the what and the how of these incredible margins, but it begs a massive question, right? When you grow your Q4 top-line revenue by 41%, you have to be selling something to someone at an unprecedented rate. So what exactly fueled this huge spike?
Section 4. Sectors driving the growth. When we examine the Q4 revenue breakdown, the modern identity of this company becomes very clear. International sales make up 33%. Defense makes up another 33%. Together, these two segments now command a massive 2/3 of total quarterly revenue. They aren't just a side part of the business anymore. They are the absolute driving force. The true outlier here is the year-over-year comparison strictly for the defense sector. It jumped from 430 crores in Q4 FY25 to 1,008 crores in Q4 FY26. That is a 134% explosion in just a single year. Understanding this specific sector's hypergrowth is the vital context you need to grasp the entire quarter's success.
It's not just defense, though. International sales grew 32%, and housing and infrastructure grew 25%. Now contrast those soaring sectors with the traditional Coal India Limited segment, which actually contracted by 6%.
What the data clearly shows here is a deliberate market pivot. It's a strategic transition of capacity away from legacy segments and straight toward higher growth international and defense markets.
Section 5. Assessing financial health.
We always want to impartially report the data as it stands, and the data does show an increase in total borrowing. Total debt moved from 946 crores in FY25 to 1,468 crores in FY26. But think about it logically. When you are scaling operations to meet a 134% surge in defense contracts and pushing total sales toward 10,000 crores, you need heavy capitalization. The question isn't really whether they have debt. The question is whether they can afford it.
Well, the context around that debt is extremely reassuring. While total gross debt is up, their net debt sits at 867 crores. And more importantly, their net debt to equity ratio is an incredibly low, healthy 0.13. So despite taking on more capital to fuel this massive expansion, their underlying financial foundation remains remarkably stable. They are definitely not over-leveraged and have ample equity backing up all this growth.
Which leads us to our final thought. We've seen a staggering 61% profit surge in the final quarter, driven by massive operational efficiencies and a very smart pivot into the booming defense and international sectors. Yet despite this hypergrowth, they maintain a net debt-to-equity ratio of just 0.13. They have the momentum, they have the margins, and they absolutely have the balance sheet. So I leave you with this. Is the engine of solar industries just getting started? Thank you so much for joining me for this explainer. Keep your focus sharp, and I'll catch you next time.